The final piece we need to add to our model is a terminal value to take into account the fact that we expect Evergreen to continue operating indefinitely into the future. To this point, we've discounted our 5-year forecast of unlevered free cash flows using our weighted average cost of capital. But we've only captured those 5 years, and to account for all future cash flows beyond our explicit forecast, we need to calculate a terminal value. What we're ultimately looking to determine is the value at the end of year 5 of all cash flows expected beyond our explicit forecast period, and then we'll discount that amount back to today. And in many discounted cash flow analysis, ours included, the terminal value can represent a large portion of the total enterprise value, so it's important that we understand how to handle this step. Now, there are multiple different ways to go about this. One common approach in practice is to determine an exit multiple and estimate the terminal value of the enterprise by applying this multiple to the relevant financial metric. For example, we may determine a business like this commonly sells for around 10 times trailing year EBITDA. So we could estimate a terminal value by multiplying our forecasted year 5 EBITDA by 10. Or maybe we think revenue is a more reliable metric and determine businesses like Evergreen typically sell for 2 times revenue. We could use the same approach and double our final year 5 forecasted revenue to determine our terminal value. Clearly, this approach relies on information about comparable market transactions, and while widely used in practice, for our purposes, we'll focus on a more finance-driven method based on perpetuity growth. So another common approach, and the one we'll use in our series, is to assume Evergreen will continue to produce cash flows in perpetuity. We can then use a model like the Gordon growth method to calculate the value of those cash flows growing at a constant rate in perpetuity. With this method, we assume cash flow will continue to grow at a constant rate forever. And the formula to calculate the value of those cash flows is our final explicitly forecasted annual free cash flow multiplied by 1 plus our estimated long-term growth rate divided by our discount rate less the long-term growth rate. So let's see how we can implement this in practice. Let's assume our estimate for the long-term growth rate of Evergreen is 2.5%, just a bit above long-run annual inflation. And this is important. Our long-term growth rate should generally not exceed the long-term growth rate of the overall economy. Otherwise, we'd be assuming that in perpetuity, the company will become an ever larger share of the overall economy, and eventually larger than the rest of the economy itself. So we want to be careful that we're not too aggressive with our long-term growth estimate. Then let's add a label here. We'll call this terminal value Gordon growth. And we can then calculate our terminal estimate as our year 5 cash flow multiplied by 1 plus our long-term growth rate divided by our weighted average cost of capital of 8.7% less the long-term growth rate of 2.5%. And given our year 5 unlevered free cash flow forecast of $709,286, we've calculated a terminal value estimate of $11,726,098 using the Gordon growth model. One way to think about this is that our assumptions imply a terminal value of roughly 16.5 times our year 5 free cash flow, which is reasonable given that this is a stable business growing modestly into perpetuity. But this is the undiscounted amount, and we must now discount this back to today to determine its present value. Importantly, because the terminal value represents the value of the business at the point in time where our 5-year forecast ends, we use the year 5 discount factor of 0.6589. So the present value of our terminal amount is $7,726,909. And this figure represents all future cash flows beyond our 5-year forecast. Recall that we discussed earlier that the number of years we explicitly forecast forward is up to us. There is no set requirement that we forecast for 3 years, 5 years, 10 years, and so on. And this terminal value calculation is why. The best way we can go about our analysis is to forecast for whatever period of time is reasonable to explicitly forecast. keeping in mind that the further we forecast into the future, the more unreliable our estimates become. And again, 5 to 10 years is a common approach in a discounted cash flow model like this for a business acquisition. We're implicitly assuming that we can reliably forecast the unlevered free cash flows for 5 years, and after that expect them to continue to grow at a long-run constant rate. Now, just to prove this, let's do a little bit of scratch work and sum up the total discounted cash flows over our 5 years. If we include the terminal value, we get a total of $10,246,740. And we'll look closely at that in the next episode as we interpret our results here. But if just for fun, we were to add a 6th column here, and let's forecast our 6th year unlevered free cash flow as $709,286 multiplied by 1 plus our long-term growth rate of 2.5%. And now let's calculate a year 6 terminal value. So if we were to use this year 6 number, multiply it by 1 plus our long-term growth rate, divided by our weighted average cost of capital less the long-term growth rate, you can see we have a terminal value in this instance of $12,019,250. Now we can copy over this formula to calculate our factor for year 6. And if we multiply by that to get our discounted cash flow in year 6, we would calculate a terminal value in year 6 of $7,286,183.58. But now let's sum up the totals. We'll first sum up our 5 years of forecasts, then the 6th year of cash flow that we based on our long-term growth rate, and finally our terminal value in year 6. And you can see we get the exact same present value, $10,246,740. And this would continue to be true if we continued to grow our cash flow each year by 2.5% and calculated a terminal value further and further in the future. We would always get a present value of $10,246,740. So this really reinforces what we've already pointed out. We don't necessarily have to forecast for 5 years. It can be for any number of years we'd like, and then our terminal value will capture all cash flows that occur after that date. So that was just a little bit of proof of concept there. We'll delete our scratch work. So at this point, we've now calculated every component of our discounted cash flow model. We have our explicit 5-year unlevered free cash flow forecast. We've calculated the present value of those cash flows and the present value of all remaining future cash flows through our terminal value. In the next episode, we'll finish this off and bring everything together by determining Evergreen's total enterprise value, discussing how that plays into our potential purchase of the business, and looking at the sensitivity of our model to the different inputs.